What does the future of commercial real estate hold for mixed-use developments? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In Elk Grove, California, a pending proposal for the Grantline Village is drawing attention. The Sacramento Business Journal reports that the Elk Grove Planning Commission is set to vote on the city's first Maverick gas station and convenience store. But this is just a part of a bigger picture. The proposal includes plans for additional retail spaces and a hotel, aiming to create a comprehensive mixed-use development in the area. This development comes amidst a growing trend in commercial real estate where mixed-use projects are being favored for their ability to combine residential, retail, and hospitality elements. The inclusion of varied components such as hotels and retail outlets not only enhances the appeal of these developments, but also offers a diversified investment opportunity for stakeholders. While this project unfolds in Elk Grove, similar trends can be seen across the border in Canada, particularly in areas like Kitchener-Waterloo and Cambridge, Ontario. These regions are also witnessing an increased interest in mixed-use developments, providing a cross-border perspective on the relevance and potential of such projects. As cities continue to evolve, the demand for spaces that offer a blend of living, shopping, and leisure experiences is likely to grow. The Grantline Village proposal is a testament to this trend, reflecting a broader shift in the commercial real estate landscape towards more integrated and multifunctional spaces. Austin City Hall has taken significant steps forward in advancing several real estate projects that are poised to reshape the city's urban landscape. According to the Austin Business Journal, these efforts collectively aim to introduce thousands of new residential units, adding substantial density and potentially transforming Austin's skyline. One of the most prominent initiatives is the advancement of Related Companies' mixed-use plan for South Congress. This project is part of a broader trend in urban development that seeks to integrate residential, commercial, and recreational spaces, providing a more cohesive and vibrant community experience. Such mixed-use developments are becoming increasingly favored, as they offer the convenience of a live work-play environment. These developments in Austin mirror similar trends seen in Canadian cities like Kitchener-Waterloo and Cambridge, Ontario. In these areas, mixed-use projects are also gaining traction, reflecting a cross-border relevance in the approach to urban planning and commercial real estate development. Both regions are experiencing a shift towards creating spaces that cater to multifaceted urban lifestyles, making them attractive to investors and residents alike. The move by Austin City Hall highlights the growing demand for residential units within city limits, driven by population growth and a desire for more integrated community spaces. This mirrors patterns seen in other major cities where urban densification is prioritized to accommodate expanding populations while maintaining quality of life. As the developments in Austin progress, they set a benchmark for other cities looking to expand their residential and commercial capacities. The emphasis on mixed-use projects underscores a broader trend in commercial real estate, where such developments are seen as key to sustainable urban growth. This is a pivotal moment for Austin, as it embraces new architectural and planning paradigms to meet the needs of its residents and businesses. Blackstone, a major player in the investment banking sector, has recently agreed to purchase nearly $1 billion in loans from First Internet Bancorp. This transaction is part of Blackstone's significant push into private credit, which has seen the firm amass over $22 billion in commercial real estate debt over the past 2 years. The deal involves funds associated with Blackstone real estate debt strategies, acquiring up to $869 million in performing single-tenant lease financing loans. According to the details of the agreement, the loans are set to be sold at approximately 95% of the unpaid principal balance. First Internet will continue to provide customer-facing debt service support, ensuring a seamless transition for the portfolio. The debt in question includes loans associated with pharmacies, quick-service restaurants, and car washes. This acquisition represents around 20% of First Internet's debt portfolio and the majority of its single-tenant business. The retail properties involved are spread across the United States, focusing on outparcels and a diverse mix of tenants. Ken Lovick, the chief financial officer of First Internet, conveyed that this transaction is expected to close around September 18th. Lovick also mentioned that the sale would help First Internet manage its balance sheet and address credit issues in its franchise finance and small business loan portfolios. Blackstone's aggressive expansion into commercial real estate debt is noteworthy, with the firm having closed its BREDS 5 fund in March, raising $8 billion. This strategy is designed to capitalize on capital dislocations, allowing Blackstone to acquire discounted deals and expand its holdings in the market. The firm has also made significant acquisitions, such as a $2 billion portfolio of performing multifamily and retail loans, and a $1 billion portfolio of senior mortgage loans. For First Internet, the transaction provides a pathway towards achieving near-term profitability goals by reducing its balance sheet size and managing interest rate risks. The bank aims to grow its net interest margin through new originations and is targeting a 2% growth rate for its loan portfolio in the upcoming quarters. Additionally, First Internet is working to expand its partnership with Blackstone into new single-tenant debt underwriting opportunities. An interesting development in the commercial real estate scene is unfolding in Chicago's Fulton Market, where a Chicago-based investor has made a significant investment in the downtown apartment market. The investor has acquired The Mason, a 263-unit, 14-story high-rise located at 180 North Ada Street, for nearly $90 million. This purchase reflects a strong belief in the upward trajectory of the downtown apartment market. The sale price for The Mason was approximately $89.5 million, which translates to slightly more than $340,000 per unit. This price is relatively lower than other Fulton Market apartment towers, such as the Fullbricks Apartments and the Parker, which have sold for higher per-unit prices in the past year. The Mason, built in 2018, offers rents that are lower than more recently constructed properties, indicating potential for rent growth given the limited new apartment deliveries expected in the near future. Casey Mogg, Vice President of Acquisitions at Waterton, the purchasing firm, highlighted the favorable supply-demand dynamic in downtown Chicago and the quality features of the units and common areas at the Mason as key factors making this an attractive investment opportunity. Waterton plans to upgrade the property, focusing on flooring improvements in the units and enhancements to common areas and amenity spaces. The seller, Naperville-based Marquette, has been active in developing apartment buildings in Fulton Market and the West Loop over the last decade. The Mason was put on the market in April, and while the total development costs were not disclosed, the property has maintained a high occupancy rate of about 95% as of April, with an average lease rent of $2,720 per month. The broader context of this transaction is that developers are currently facing challenges in securing financing for major construction projects downtown. As a result, there are few new apartments scheduled for completion in the next couple of years, which has contributed to a 6.4% year-over-year increase in net monthly rents at Class A apartment buildings downtown, according to Integra Realty Resources. This acquisition by Waterton in Chicago can be compared to trends in Canadian cities like Kitchener-Waterloo and Cambridge, Ontario, where similar dynamics are at play. In these regions, the demand for multifamily properties remains strong, and investors are keen on capitalizing on the limited supply and favorable market conditions, making them attractive targets for investment. The redevelopment of the former Willow Grove Naval Air Station in Horsham, Pennsylvania, marks a significant milestone in the transformation of this long-dormant site. According to a report by 6 ABC Digital staff, the redevelopment plan includes the creation of a town center, an office park, and some housing, promising to revitalize the area and boost the local economy. With the site vacant for nearly 2 decades, the new development, named 862 Rising, aims to transform 862 acres of unused land into a vibrant community hub. The project is set to provide spaces where people can live, work, dine, and shop, aligning with the growing trend of mixed-use developments in commercial real estate. While the agreement between the Horsham Land Redevelopment Authority and the United States Navy to redevelop 118 acres of the property is welcomed by many, it also raises environmental concerns among residents. The main issue revolves around water contamination linked to PFAS chemicals, which were previously used at the base. Local leaders have assured the public that the redevelopment will prioritize safe drinking water, with stringent processes in place to capture and clean any contaminated water during construction. Bill Whiteside, president of Horsham Council and chairman of the HLRA, emphasized that all necessary measures will be taken to ensure environmental safety. Supporters of the redevelopment project highlight its potential to create thousands of jobs and significantly boost the local economy. Serena Marone from Ambler expressed optimism about the job opportunities and economic benefits the project will bring to the community. The redevelopment is expected to commence within the next 12 months and represents nearly 10% of Horsham Township. This development aligns with similar trends observed in Canadian regions like Kitchener-Waterloo and Cambridge, Ontario, where mixed-use projects are also gaining momentum, reflecting a shared cross-border interest in revitalizing underutilized spaces. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.